Hi, welcome back to You Heard It from a CFP, episode 65 of You Heard It. My name is Matthew Coyle. I'm the Director of Financial Planning at ACG. Was that the top? We start today's episode with a question. Was that the top in interest rates, or at least the temporary top? The market is trading like we just may have seen a temporary top in interest rates. We're going to look at a couple things and what it might mean for you. Let's dive in. Well, stock market might get all the attention, but the most important part of any market is what determines what things cost, which is interest rates. And that is by far and away the most important part of the market is rates and the bond markets. It may not get all the attention, but it is more important. So let's take a look at our first chart here today. And I want to go over a couple things that I think might show you we may have seen a top, or at least a temporary top, in interest rates and what that might mean for the rest of the year for you as an investor. No guarantees, but where you may want to place their bets. But more importantly, where's the market placing its bets for the remainder of the year? So let's start by looking back, not forward. We'll look back at 2022 right now. And what you're looking at here is a combined chart of the S&P 500 and the Bloomberg Aggregate Bond Index, the worst combined performance. Of course, if you were an investor in 2022, you know this is nothing new. However, what drove this? Why did this happen? Why is 2022 such an outlier? On this chart, of course, you can see every year plotted since 1976 through 2022, and just the oddity of 2022 and how weird of a year it was. Well, that was being driven by rates, okay? An increase in interest rates. Really, really quick. Certain assets are affected by interest rates in ways that others aren't. The shorter an asset's limited duration is, or the shorter an asset's life is, the less it probably is going to be affected by interest rates. The longer its life is, the more it's going to be affected by interest rates, generally speaking. Okay. What drove this in 2022 was the very, very fast increase in interest rates by the Federal Reserve. All right. So, with that in the rear view mirror, let's look in through the windshield and let's look and see what rates are being priced in for the remainder of the year and why it's so important. All right, before we do anything else, just a really, really brief bit of background on what happens in the market with interest rates and values. Like I said, the longer the life of an asset, typically, generally speaking, the more it's going to be affected by interest rates than something that's very short lived. So, for example, a treasury bill with less than a year maturity is not going to be affected much by interest rate expectations out 2-3 years, right? It's not going to affect it very much. A growth stock with a technically unlimited life to it, with a lot of forward earnings in front of it, is going to be affected a lot more by movements in interest rates. And that's one reason why you saw such poor performance in 2022 in tech stocks and information services type companies. Now, fast forward to 2023, what are the best performers thus far through March 28th in the market? They are information services and technology. Thank you, Fidelity, for this chart. So, given that backdrop, and given the fact that interest rates affect products differently, where should you put your money? And what is the market telling us is their bet on where interest rates are going? Well, to understand that, you have to understand what type of information you want to look at to see what banks are expecting, because banks are the biggest buyers of interest rates in the market. You are a tadpole compared to JP Morgan Chase, who buys, or Bank of America or Citi, or anybody who buys interest rate futures in the open market. Now, much like a corn farmer can buy corn futures to hedge their position, or a grain farmer can buy grain futures in the open market to hedge their position, banks are no different. Banks have loan portfolios. That is their asset. Okay. The money sitting in your checking account, that's a liability to them. That's not an asset for them, because they have to give it to you if you show up. Their asset are their loans that they're going to get, right? That you're paying on your mortgage or you're paying on your car loan. So they like to hedge that inventory just like a corn farmer or a grain farmer would hedge their inventory. And the banks do this by buying futures contracts, interest rate futures contracts, which are derivative products based on pretty much any interest-bearing note, like a 2-year bond or a 10-year bond or a 30-year bond or a Fed futures contract, for example. And if that is the case, which it is, what are they telling us? Cue my next chart. If you look at the forward futures contracts on interest rates for the remainder of the year, this is what you see. On the federal funds rate, banks are expecting the future rates to fall through the remainder of the year. Now, what does this mean for you and why is this important? Let's turn this chart off for 1 second. If this is the case and banks expect interest rates to fall, we look back to 2022 again. What were the worst performing asset sectors? Information services and technology. 2023, what are the best? Information services and technology. Now, side note, this is why I always tell people to own a wide variety of assets, because you just don't know What's going to
Higher.
perform and when? Now, let's look at this in the context of what's happening with inflation right now, and you will see why banks are pricing interest rate reductions for the remainder of the year when they buy products to hedge their most important assets. Let's look at inflation. Now, it may not feel like it, but year over year, inflation is sinking and sinking fast. Now, part of that is because what the Fed is doing, and part of that is because credit is tightening around the economy, and there's not as much economic activity as there was, which is why some people are pointing to a recession. But the jury's out on that at the moment. So year over year, inflation peaked sometime last year around May or June, right around 9%. This comes from the Bureau of Labor Statistics. It is now falling and has fallen down to about roughly six, maybe slightly under six as far as year over inflation. So inflation, even though it may not feel like it, the data is very clear. Inflation is falling and it's falling like a stone. It's falling very quickly. And pretty soon, on a year over year basis, we might be flat as far as inflation goes on a year over year basis. So the banks see this, they track it very closely, they know, and that's why interest rates are falling. So, with that all said, what should you do as an investor? Where would you place your bets based on where the biggest players in the most important market are placing their bets? Again, no guarantees, but what would this likely favor? Let's look at that now. All right. Let's start off with a full disclosure. Your situation may differ. Before I get into what areas may benefit or not benefit, your situation will differ from your neighbor's situation, which is different from my situation, which is different from your parents' situation, which is different from anything. If you have a hard stop purchase coming up in the next 24 to 36 months, a home, college education, a big spending purchase, something that is definitely a hard stop, non negotiable, it has to be paid at a certain time type of purchase, don't you dare put that money in the market. Be smart. Be smart about it. Put that money in CDs, cash, money market funds, short term instruments, treasury bills, whatever it is. Do not put that money in the stock market just because Matt said to. Okay, this is general purposes only. This is not meant to be advice specifically to you. If you're a client, you can call us. If you're not, you can call your advisor or just do some more research on your own to determine if that's right for you. This is meant for general purposes only. Do not do this just because Matt said so. All right. Now, typically when interest rates fall, let's assume the banks are correct. And interest rates through the end of the year do fall. What's the first thing you'll notice is that bond prices do historically tend to rise. Let's talk about bond prices for 1 second. One of the great disappointments of 2022 was the performance of bonds. It was the worst bond market performance really ever recorded since we've been keeping records on this kind of stuff. But it is the great disappointment of 2022 was not necessarily stocks. Stocks can have off years, and it happens, periodically. Bond market portfolios did particularly poorly in 2022. It was horrible to be a bond market manager in 2022. I felt very bad for people who were looking for income but could not get it. And when they went out far in the interest rate curve, they got absolutely hammered because those bond portfolios, especially long-term bonds, did very, very poorly. Now, conversely, when rates fall, long-term bonds tend to rise. So if you are a long-term bond investor, this might be good for you. Again, full disclosure, your situation may differ. But that's the first thing as you might see is long-term bonds, intermediate and long-term bond prices tend to rise when rates fall. Okay, next up, I'll do three of these. Next up, growth stocks. Growth stocks do tend to rise or fall based on interest rate changes, and we've seen this the past couple of years. If you are a growth stock investor, you're probably going to see values in growth stocks rise, and we've seen this in the start of 2023, right? I just mentioned earlier in the video, information technology, communication services, things like that are doing quite well year to date in 2023. If you are a growth stock investor, you will likely see growth stocks increase in value continuously as rates fall because the current value, the present value of their future earnings is worth more because they're being discounted by a lower and lower rate, aka the share price rises. So, if you are a growth stock investor, remember that now might be the actual perfect time to put money to work as interest rates theoretically fall because the bond value, the stock values will traditionally rise. Is it right for you? Do your own homework or consult with someone who you trust. But if you are a growth stock investor, growth stocks typically do fairly well in times of interest rate decreases. And of course, the big one, home values. Most people who own a home, this is where they first experience the wealth effect. It's not in their market portfolios because in their mind, that's much longer term. Their home value tends to be where people feel it the most when interest rates rise or fall. Right now, we've seen a very clear slowdown in home values. The market just isn't really moving right now, not much. I've seen some sales around my area, and you've probably seen a few around yours too, but for the most part, they haven't been that active as far as listings or sales. So typically, when interest rates fall, home values rise. Not as much as, say, growth stocks would, but they typically do rise. Anytime there's a decrease in rates, it makes that home cheaper. and you'll probably see any residential property or residential connected properties like public storage or things like that. That typically does better for those industries than it would in a rising rate environment. So if you see a rate a decrease, as is being predicted by the market, residential home values, anything connected to residential home values, typically does okay during that time frame as well. Other things you tend to see, and I'll add a couple more here real quick. Commodities prices tend to rise when interest rates fall. And of course, bank CD, savings rates, money market funds, those rates tend to fall, of course, as rates tend to fall because they typically track the either Fed funds rate or the 2-year bond note, for example. They'll track that. So that's pretty much it as far as a coverage on rates and values. So do your own homework. If you have an advisor you trust, talk to them. If it's us, great. If it's somebody else, you can talk to them as well. Thanks for sharing your time with me. I appreciate it as always. It is your most valuable asset, as I like to say. You have a very nice time, and I will speak to you next time on episode 66, whenever that is. So thanks again for watching. Take care.